Ladies and gentlemen, welcome back to the channel. AMC Stock is down about 1% at the time of recording this video. This is actually a very strong day for AMC, and we're going to break down exactly why and what the heck is going on with this stock. Everything you need to know. Hit the like button and subscribe to the channel and source your comments, questions, or concerns down below in the comment section. So if you take a look at what's happening out there in the markets, the S&P not doing so great. Most stocks are not doing so great. The NASDAQ is down about 1.5%. AMC's down less than the NASDAQ. Just being down 1% is a pretty good day these days for AMC. So what's going on? What do you need to know? Well, I think the number one thing to consider is the stock is in deep value territory. It's no longer expensive. It's no longer being valued as even a meme stock. You're not getting the volatility premium to AMC anymore. So I do think you're at the point where the stock is just sold off so much that it's one of those situations where the risk to reward makes a lot of sense when the returns could still be very large. Like I said in the last video, the odds of AMC going to $12 per share, increasing 50% from here, rather than dropping another 50% down to $4 per share on a pure valuation basis. I mean, what's the most likely outcome? Well, obviously it would be a rally to 12, since you've already fallen like 80% within the last couple of weeks, and the stock is not going bankrupt. Unfortunately, the shorts want to see the stock go bankrupt, but that is not happening. Now, there's a couple things going on in the markets today, and I think we should acknowledge that here now before we get into some of the other things we're going to talk about in this video, because I mean, you guys deserve to know what's going on and why the markets are down so big. So Michigan Consumer Sentiment Survey came in at 67.7. Now, this was better or worse than the estimate of 69.1. This is not good, but it's not bad. We're still much higher than we were before. What's actually crazy is the 1-year inflation expectations went down to 3.1%. This was a big drop from what we've seen at 3.5% for the past couple of months. Now, why would inflation expectations fall in the 1-year basis? Well, if people are seeing or really maybe seeing other people, but themselves not willing to pay higher prices, well, that would be a reason. Now, the 5-year inflation expectations went down to 2.7%. This is more so a sign of a weak economy than it is just inflation expectations organically coming down. Because when inflation falls, it's usually because of a recession. Usually when you get periods of really high inflation, almost hyperinflation, you tend to see recessions, because eventually the purchasing power of individuals is so deteriorated that people just can't buy as many things and don't want to when they see prices way higher than they were in recent memory. So these drops in inflation expectations look like, to me, kind of fear in the economy and a sign that the economy is getting worse. Now, the other thing that happened is the Michigan current conditions for September came in at 69.8. You were expecting 75.3. So, not great. Okay, just all around, this survey was not good for the markets. And it's a big survey for the markets. It's been running for 70 years, and this seems to be a more kind of forward-looking survey, because we're getting this data, the survey for the month of September. It's currently September 15th. So this is not lagged data. There's no revisions that really happen to this data. This data is the data for the month of September. Sure, there is some revisions like there is on all data points, but not like the non-farm payrolls get revised 100,000 or so, for an example. So this very much recessionary, okay? So just to you guys that are out there watching this video, you really want to have your financial situation in check right now. There could still be some time before massive layoffs start, or just layoffs in general start. If you're in a relatively new job, you might want to really consider getting into something that is less economically sensitive. That's probably not a terrible idea right now. It's not a terrible idea to save a little bit more money. It's not a terrible idea to put more money into your brokerage account waiting for stocks to ultimately fall. Remember, recessions have created more millionaires than lottery winners times 10. So recessions is really, if you're capitalized for it, usually a pretty not good thing, but it's good for those of you guys that have the money to be involved during a recession, to invest during one. And that looks to be the direction we're heading. Now, I know you guys don't like this individual. I don't like this individual. Nobody seems to like this individual. But Ken Griffin yesterday, you guys might have seen this. We were talking about it in the trading community. If you guys want to join that, link down below in the description of this video. But Ken Griffin went on CNBC yesterday and said that essentially the economy is, quote, very quickly heading into a recession. That's what he said. Now, a couple things that stick out to me here. Ken Griffin and Citadel gets paid for people trading. So they want to see as much trading as possible. Very much incentivized to say things that will lead to as much trading as possible. Because, I mean, if you come out and say we're very quickly heading into a recession, well, that's not exactly very encouraging to your trading business. Citadel, right? The market maker. So there's a lot of speculation on why Ken Griffin said this. I honestly think he did not mean to sound so honest. I just don't. And if there's anyone out there, let's think about this logically. If there's anyone out there that knows what's going on or what's going to happen, it is Citadel. It is the market makers. Citadel controls about 30% of the order flows, and they have to keep a lot of capital on hand. Ever since 1987 and Black Monday, when market makers failed and did not have enough capital to backstop the markets, and markets fell 20% in a single day, and now you have halts for the markets to basically give people time so they don't panic. All of that stemmed from 1987 and market makers having not enough capital to facilitate transactions, to buy, sell, really keep the markets afloat. So imagine it like this. If the U.S. government heard that something really bad was about to happen in China, maybe all U.S. companies were going to no longer be allowed to do business in China, for an example. This is just an example. The first people the government would call are the market makers. That's it. It's the bottom line to it. Because they want to make sure at least our financial markets do not collapse off of this and go into a very deep recession. So, and I think you guys could probably agree with that. So that was quite concerning for the markets. I think a lot of people are digesting some of this data that we've gotten over the last couple of days. But even on top of that, the seasonality of September tends to work like this. So today is quad witching. That means that your option derivatives expire today across the board for basically all different kinds of option derivatives. Now, September, as you've heard, seasonally is a very weak month for the markets, but actually, up until quad witching, tends to be pretty bullish in September. As you can see from this chart, from data from 1950 through 2021, tends to be pretty bullish. What actually happens after quad witching, which is the third Friday of the month, that's where you tend to see the actual sell-off. This happens for a couple of reasons. A lot of hedge funds and institutions, their calendar years end in October, so that makes sense. A lot of hedge funds sell and all of that. And then a lot of investors are just repositioning the trillions of dollars of options, right, that just expired on that quad witching in September. And then you also have investors looking forward to 2024, putting on new hedges, things of that nature. So for a lot of reasons, the end of September tends to be pretty rough. So if you're out there and you're not hedged in your portfolio, maybe it's a good idea to do so. That is what we are doing, what we have been doing in the trading community. Like I said, if you guys want to join, link down below in the description of this video. But nonetheless, let's go ahead and get into AMC a little bit more. So You do have a short score of 71, 201.5 million worth of short positions in AMC. Estimated short interest of free float at 15.7%. Free float out on loan at 13.2%. Shares out on loan 26.11 million. Days to cover 2.18. Cost to borrow 5.75%. Utilization of 59.58%. So across the board, you guys got to really take these numbers with a big grain of salt. Really, I wouldn't even believe most of these numbers. Like, look at the live short interest of free float. The estimate is 12.74%. The last exchange reported number we got was 16.5%. So, I mean, the numbers are moving around a lot, and they're not accurate. But I want you guys to also know that the short interest of free float looks like it fell from 29% down to 16%. That is because simplest way to put this, the float is larger because AMC just sold 40 million shares, but the amount of shares sold short just went up at a record pace. It just went up 36%. So the actual net shorts increased quite a bit. So that's important to know, and I do still think AMC stock is very much squeezable. You just need to get something to actually do it. You need to see a good catalyst. You need to see maybe weakness in the markets. Maybe that's what we need to see. Maybe that would be very beneficial to AMC in the second half of September if AMC can just do okay and see the markets come down. That could restrict some liquidity and buying power out there, and that could put some pressure on the shorts. The shorts have been in their positions a long time. A lot of shorts have these cost of borrow fees that have really eaten into their positions, that maybe some of them are still not even profitable on their short position. So that is kind of how I'm thinking about this situation. Think about it as you please. Let me know down below in the comment section how you are thinking about this. But yeah, so the option activity, we're not getting any data here, but if you do look at the options that expire today, 64% of the volume is calls and 36% is puts. Now, I think it's more important to look at the next couple of weeks, and strangely enough, September 22nd is very negative as far as volume today. 15.5% of the call volume today. 85% or 84.5% of the total volume is puts. So you're seeing a lot of bearish positioning for next week. I think that's just maybe some hedging or maybe some institutional investors coming in there and taking out some positions. We'll have to wait and see. September 29th, not nearly as bad. 66.5% open interest on the call side, 33.5% open interest on the put side. Volume today of 63%. Now, the next biggest option expiration is October 6th. And I know that's not a huge option expiration, but it's the next biggest one. You have 61.3% open interest on the call side, 38.7% open interest on the put side. So all in all, this week is pretty bullish, right? Next week is very bearish, and then the following weeks are bullish after that. So we'll ultimately have to wait and see what happens. But when you net this out, people are looking pretty bullish compared to what we've seen recently. And if you look at the put to call ratio over here, we'll go ahead and blow this chart up so everyone can see. I mean, the put to call ratio was really just at sky high levels from January until today, essentially. And you were at a high of almost 2 puts for every 1 call. Now you're back down to 1.26 on the put to call ratio, the lowest level we have been at in quite a long time. So this just shows you the overall barometer on option positioning from hedge funds and institutions, guys. So there is that. The stock go tracker data for this Friday. You got about 68,500 calls currently in the money, 207,000 calls out the money, 114,000 puts in the money, and 270,000 puts that are currently out of the money. So a decent amount of option activity this week. And a decent amount of calls and puts, honestly, expiring in the money. A little bit more puts, obviously, but we'll see what happens towards the end of the day today. $9 is a pretty important strike for this week, but I do expect a lot of this dollar amount, kind of these options, to flow back into next week and the following week expirations. Also, the next really multiple weeks. October 20th looks like it's going to be your next major option expiration, but next week already has some sizable numbers. About 14,000 calls currently in the money, 55,000 calls out the money, 13,000 puts in the money, and 113,000 puts that are out of the money. So a decent amount of option activity. And then you also do have a lot of FTDs, millions, around 4 million FTDs that come due today, and about 4.5 million FTDs that come due coming next Monday. So it's going to be a lot of option, a lot of failure to deliver activity that could fuel even more FTDs to come with some of the option activity that we are seeing. And for whatever reason, hedge funds, institutions, market makers, they love to have FTDs on AMC. So I do still think, like I said, look at the outperformance today of AMC compared to the broader markets. It's stellar. I mean, AMC is doing phenomenal today. So you really want to pay attention to these bad days in the market and how AMC stock is doing. If I were to guess, AMC stock inverses the markets and could have a pretty good next couple of weeks would be my expectation. And again, the risk to reward profile of AMC looks really good at these current levels. So that's going to do it for this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. We have a lot more to discuss in the next video, so stay tuned for that one. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.